Okay, there we go. All right. And then I will take a minute and I want to introduce you guys to Lisa. We've been chatting a little bit, those of you that were on the call before now, but we've been working with Lisa for, gosh, for as long as I've been part of Briggs Freeman, I would say. She's an awesome lender. She's with Cornerstone Home Lending, and she's super knowledgeable, knows what she's doing, and she always helps us teach this class just to introduce you guys about financing. Lisa, I don't know if there's anything you want to share about yourself.
Well, I'm old, so I've been in the business a long, long time, and I've always been in the Dallas Metroplex area. I actually got in the business when, okay, do you guys know who Ronald Reagan is? President. That's how long I've been in the mortgage business. So I've seen so many changes, and it just is completely a different business than it was that long ago. And now finally everyone's catching on to Texas. All of a sudden the secret's let out and everybody's moving here. And it's so exciting because I have never been this busy since I've been in the business. And it just continues to like be just slammed. So it's really good. And it's a great time to be in the business. So I just want to say thank you, Zareen, and congratulations to everybody being on board with Briggs Freeman, because they are the absolute best, not only locally, but globally. I work with a lot of the agents and they are so professional. The level of service that they provide their clients is just bar none. I mean, it is fabulous. And I just love working with them because it actually makes my job a lot easier too. So it's a good partnership, and congratulations for being on board with the best.
Well, thank you for helping us be better and taking the time for us.
Oh, my pleasure.
Real quick, do you just want to walk through what we're going to cover today to give the agents kind of a roadmap where we're going?
Yeah, so we're going to kind of go through best practices when you're working with the lender, how the mortgages work, because there's different types of mortgages. They're basically all the same. It's just, you know, little nuances in each one. And the different types of loans, FHA, VA, that sort of thing. And then we're going to go through some of the addendums on the contracts, because there's probably 3 or 4 that really people get stuck on. So we're going to just go through that real quick too. But other than that, we are ready to go. And Zareen, I've got on this, I've got to click on something here. There we go. Okay, I just had to clear that screen. So we're going to just jump right in. 80% of your buyers are going to be getting a mortgage loan. Okay, so it's real important to work with the lender or have a lender and build your team so you can just reach out to them. And a lot of times if your client comes in and they're already working with the lender, they can always get a second opinion with somebody else too. But the most important thing is get them pre-approved right off the bat, pre-qualified. You're working with someone that said, oh, my lease does not expire for 6 more months. That's the perfect time to get pre-approved, especially for first-time buyers, because behind the scenes, we are able to work with them if there's any credit and, you know, things they need to maybe work on, get their credit score up a little bit more, kind of go through what to expect on closing cost and down payment and first-time buyer programs that they can train for. So when their lease is up, they are ready to go and they're going to be confident, and you're going to be confident and be able to offer, you know, get a quick close under your belt on that one. So that's probably the biggest thing, is pre-approvals, pre-qualified. And the difference between those two is a lot of lenders will just look at basically what the client has put on their application and say, okay, you're pre-qualified. Pre-approved is the next step where we actually run it through the underwriting process. So you get a stronger pre-approval letter. So basically we have looked at everything, their income, their assets, their credit, and we run it through the automated underwriting system and we get the green light. So they're pre-approved. So that is probably a much better option to go with, but then you'll see a lot will come in with a pre-qualified letter. When you're writing a contract, you always want to put the approval letter or pre-qualification letter with the contract. That's going to be populated with the property address, the loan amount, and then it will tell the type of loan that they are getting. So that's real important when you're putting that information in the contract. You'll just actually look at your pre-approval letter to populate the loan amount and the type of loan and that sort of thing. So anytime when you have a question, just reach out to your lender. They're all pretty much, local lenders are always available for you on the weekend, after hours. They're always going to be there for you. If your client's working with like a big bank, it's a little bit more narrow, constricted on how you're going to be able to communicate with them. A lot of times they don't answer over on the weekends if you need a pre-approval letter. So it's really nice to have a local lender that you can depend on. I can't tell you how many times I'm doing pre-approval letters on a Saturday evening at 9 o'clock or a Sunday morning, but that's when people really need it. That's when people work. That's when people are actually making these offers. And now more than ever, it's just so important to have that available to you when your buyer is ready to make an offer on a contract.
Yeah, and I'll jump in and say, like, when when an agent calls and they're like, on my listing, the buyer's loan isn't working, the first question that I ask is like, who's the lender? And if it's someone like Lisa or someone local, you can pick up the phone and call them. If they're like, oh, it's Wells Fargo, it's like, you don't know who's the right person, and the file gets passed around to different people. And so on the listing agent side, that's just something to be aware of. If you might get an amazing offer, but if the lender is Wells Fargo, you just need to be aware that there will be likely more hiccups with a big bank, on the listing side when you're looking at offers. And also on the buyer side, if you have a buyer that's committed to using Wells Fargo, just know that agents and sellers might be a little bit more hesitant because of that. That's just something kind of you guys should be aware of.
Good point. Another thing too, with the big banks, they cannot get them closed quickly. I mean, a 2-week close to a big bank is not going to happen. And sometimes they can't even get them closed within a 30-day time period. So if that is important, and now, I mean, the average turn time that I do is between 2 weeks and 30 days on contracts, because people are just wanting, get in this, even if the seller has to lease back for 30 days, they just want to get that deal done. So the quicker that you can have a closing, the better in most cases. And then also what's great is when you are working with the lender, what we do is we have auto-generated emails that go out. So when I get your client and they're applied for the loan, the listing agent knows when that loan goes to underwriting. They know when the appraisal's been ordered. They know when the closing CD goes out, when the documents are released to title. So everything is transparent and they get all of that information. And I get such great feedback from listing agents on that. They just love that. So that's real important. So if you do have a listing, that is something that will really help you too when you have a lender that will communicate the process of that loan. So you can let your seller know, oh yeah, the appraisal's in, it came in fine, they're ready to go to closing, give them all the information.
Yeah, that's exactly right. And I think the moral of the story is that, I mean, when you're the buyer's agent, the lender should be like an extension of you. Like you guys are teammates, right? Like working together, and should be in constant communication. If I have an agent that calls me with an issue and they haven't talked to the lender in a while, that's usually a red flag. You need a lender that's super communicative. And the same thing on the listing side. If you feel like you're not getting that communication, it's totally fair to ask, like, can I talk to the buyer's lender? Some people will say yes and some people will say no, but it's okay to ask, because communication is what everyone needs to kind of get deals done, for sure.
Okay, so the 4 pieces of the mortgage puzzle. I'm going to jump over to credit because I think credit is king. The higher the credit score, the lower the interest rate. The higher the credit score, the lower the mortgage insurance rate. So if you have someone that's putting 5% down or less than 20% down, which most people do, they're going to have mortgage insurance, and that premium can be very low if their credit score is, say, 730 or above. So that's the most important thing. And when people apply online, we pull all three credit bureaus, TransUnion, Equifax, and Experian. And all three of those bureaus have a credit score on you. For instance, say Experian is 800, TransUnion is 750, and Equifax is 700. All lenders will use that middle credit score. Okay, so we'll take that 750 and that's what your score is going to be. A lot of companies out there, these Credit Karma, even the big banks will quote a score to their clients and they think, oh, my credit score is X. And it never is the same as what their actual scores is from the credit bureaus. So they use an algorithm that just does not jive with what is actually on the bureaus. So that's something to know, because a lot of people say, oh, my credit's 800 and, Credit Karma, and then I'll pull it and it's not quite that high. So credit is the number one thing. And that's why it's so important when you're working with first-time buyers to get them pre-approved as quickly as possible. Even, like I said, even if it's a 6 month out, a year out. I've actually worked with people 2 years because we're working behind the scenes, getting their credit to where they need to be. But once that happens, I mean, they're ready to go. And we have a program, it's called Credit Rescore, and we can actually run it and say someone comes in and they're a 700 and they want to go to 750 because there's a little pricing adjuster. The higher your credit score, the lower the rate. So we want to get them to 750 and we have some time to work with it. So I run the program and it will tell me exactly what they need to do to make that happen. So that's why it's really nice to, when you're working with people, is just get them to do this first. A lot of times they don't even need that, but once in a while they do, and it really helps them get the best possible financing and make everything go so much more smoothly. So basically, that how I feel about the credit part of it.
I have a question about that. One of the agents is asking, is there a site that you would recommend them using to figure out the score, or would you tell them you should probably just talk directly to a lender?
I have the addresses for all and numbers, all for the three bureaus. You can get a free report directly from the credit bureau. So if you want to reach out there.
Okay, we'll send that out to you guys. Okay.
Yeah, I'll send that out.
Perfect.
And then the next thing is income. Okay, so all lenders look at the last 2 years of income, and there's two types. Basically, it boils down to W-2 earnings. That's where you get your pay, and you're going to get all the taxes and Social Security. Everything's deducted out of that. And then there's 1099 income or self-employed income. And the 1099 doesn't have all that deducted out of it. So that's what throws it into the self-employed category. Now, W-2 income, I know it's not fair, but when someone comes in, say I have a client and they make $100,000 a year. So I'm going to just divide that by 12. And his income is 33 a month is what I give him credit for income. I give him gross credit for it because I'm not using his net income. I'm using the gross amount. Now on a 1099, typically they do a Schedule C, and we need the last 2 years of filed returns. So if that 1099 says 100,000, but they write off 30,000 of expenses, then I only can give them credit for 70,000. So if they had, say for 2019, if they made a net income of 50, and then in 2020, they made a net income of 70, we have to average that over the last 24 months. So as you can see, self-employed kind of hits a little harder as far as what we use for qualifying income. That's why it's really important, if you do have self-employed people, definitely get them pre-approved first, because a lot of times they'll think, well, I made this much, and the gross amount, like on their 1099, I made this much. They're not looking at what it ends up being after they write off expenses. So that's a good thing to know when you're working with self-employed people. But I love W-2. W-2 is real easy. They can have 2 or 3 jobs within, a couple of years, as long as it's in the same type of work. And whereas 1099, you need 2 solid years of filed tax returns to be able to use that income. And then let's go to the debt.
Oh, sorry.
So when we pull the credit report, it will have revolving charges, car payments, student loans, and that's all we basically use for the debts. And if they pay alimony or child support, we use that too. But if they pay like tuition for their kids or insurance, we don't use that into the debt ratio. So we basically take anything on an installment loan that's more than 10 months, and that's included in their ratios, and add that to the monthly mortgage payment to make sure the ratios do not exceed the requirement. And if this is why credit's so important, because if their credit score is really high, there's so much more flexibility on ratios. I could go up to 50% sometimes on ratios if we have a really solid credit and employment. So it's kind of like all of these pieces work together, and the better, the stronger the loan, the more flexibility that client is going to have in underwriting. Assets are, of course, checking, savings, 401ks. A lot of people nowadays are tapping into their 401k for the down payment on the house, which is a great source of money. A lot of them can borrow up to half of that, and they're just paying themselves back. And so they can amortize it over a long period of time, so that payment's really low. And it's a nice way to, supplement their down payment. Another thing too that I'm seeing a lot of nowadays are gifts. A lot of parents are stepping up to the plate, and they're giving big chunks of money to kids that are now buying their first home, which is great. And it's really nice because they can actually just fill out the gift form, and they can wire those gift funds to closing. So it makes it really easy. And a lot of times they just maybe will do a partial, but I've been seeing a lot of large gift going towards down payments for first-time buyers. And so it's really nice. Okay. And then the way the points work on a loan, for instance, if you have a 3% interest rate, par is going to be no discount points. Okay. So right now, someone could come in with a 750 credit score and say the rate is 3%. So they're just going to pay their normal closing cost and prepaids at closing. If they want to buy that interest rate down to 2.75, they're going to need to spend 1% of the loan amount, buy that interest rate down 0.25%. So basically that would cost on a $400,000 loan, it would be $4,000 to buy that interest rate down 0.25%. Now the difference on the payment is about $40, okay? So the break-even point would be over almost 6 years to recoup that $40 on a monthly basis. So sometimes it just doesn't make sense to buy it down unless they're going to be there forever, which the average in Dallas is 3 to 5 years. So a lot of people choose the par option. And then another option that's really been great lately is the lender credit, where you can buy up your interest rate and get a big rebate at closing to offset your closing cost and prepaids. I just had a first-time buyer that did a 3% down, and they bought their interest rate up and was credited back 3%, 3 points that covered all of their closing cost and prepaid. So they got in for just a 3% down payment. So it's a nice way to work it. And that's why the importance of getting somebody in with a good lender, because a good lender is going to give them these options and kind of open up their eyes to what's available. Because a lot of times people just get, oh my goodness, they get overwhelmed with all of it. But when you have someone that can take them and kind of go through the options and give them the loan estimate and kind of give them an example of if they do a lender credit as compared to if they do a par rate, and they can see the bottom line of what they're going to need to be closing, how that's going to affect their payment. If they're only going to be there a couple years, it might be a great way to do it, is to do a lender credit. If they're going to be there forever, it might be a good way to buy the rate down. But we give them options so they can choose the best way that will fit their needs for the biggest purchase they're probably ever going to make. Here's a quick look at the mortgage insurance. Mortgage insurance is on conventional loans, and it's required if it's less than a 20% down payment. And mortgage insurance kind of had a bad rap in the past, but it is actually an awesome tool that will allow so much more flexibility for buyers. I just had one that they were going to put 20% down, and they signed the appraisal waiver. The appraisal came in a little bit low. And so what they were able to do is bump it to 10% down, pay the gap in the appraisal, which was only, I think it was 10,000. This was on like a $600,000 purchase, but they ended up doing 10% down, and the mortgage insurance premium that you can pay one lump sum at closing was only $2,000. So literally they saved over $40,000 doing it structuring this way, and their payment was only $164 more a month by going from 20% to 10% down. So this is a mortgage insurance. When people know about it and when they see the options that are available now, it's just a really good tool to help structure financing, because it no longer has to be in the monthly payment. They can just do a one-time premium at closing, and they get a discount when they do that. So if your client is going to be in the home more than 3 years, it definitely makes sense to do the one-time premium, because they never have to worry about mortgage insurance. Their payment is just their taxes and insurance and their principal and interest. If your client is going to be transferred within a year or so, then yeah, it probably might make sense just pay that monthly mortgage amount or monthly MI amount. Types of mortgages available, and this is going to be on your financing addendum. Each one of these will be available to check on. So your conventional loan is backed by Fannie Mae and Freddie Mac, and that goes up to $548,250. So most everybody is going to be in this. This is the most popular type of financing, as a conventional loan. It's just, and then you can do as low as 3% down for first-time buyers. You can go 620 on a FICO score. Seller can contribute up to 9% towards closing costs and prepaids. And the private mortgage insurance is waived if it's 20% or less, or 20% or more, sorry. And this is not insured by the government. It's backed by Fannie Mae and Freddie Mac that we sell in the secondary market. So that's why we adhere to those guidelines on conventional financing.
Do any of you guys that have done deals have any questions about conventional loans? It's probably, especially right now, what you're going to see most frequently, because I would say it's the most basic kind.
So jumbo loans, anything over $548,250 is going to fall into a jumbo loan, and it's conventional non-conforming. So basically, they are all insured by private lenders and big banks. For example, when I have a jumbo loan, I can look on my pricing grid, and I can look at, and we get the wholesale rates from, say, US Bank, Bank of America, Chase, Wells Fargo, Redwood. We have lots of jumbo lenders we work directly with. And so we also have delegated underwriting, which is awesome, because that means we get their wholesale rate. So I can offer the good rates of the big banks with your local lender service, which makes it like just wonderful, because a lot of times if they go to the bigger banks, they don't get that service that they might get with a local lender. And each investor will have different guidelines. So maybe a Wells Fargo might require that the client, if they're borrowing $1 million, have 6 months liquid after closing, or maybe a little bit lower ratio requirement. So there's a lot of nuances on jumbo loans. It's not all cookie cutter. Each one is different. That's why it's so important when somebody is getting a jumbo loan, that when they work with their loan officer, that they can meet all of the different overlays that that investor might have. Some of them will allow gifts on jumbo, some of them are limited. So it's just really good to know what those are. And that we are able to close those in our name, Cornerstone, and then the servicing is released to the, the investor.
So just something to be aware of would be, know that it's going to be, if it's above 548, it's going to be jumbo, not just conforming. And there's just some additional criteria, so you need to be aware of that.
And it's typically a 20% down payment. So, you'll see that most people will do 20% down. There is money out there for 10% down, and ways that you can get a second lien. So, but standard jumbo up to 2 million is going to be 20% down. And then FHA is great for someone that maybe has a low FICO score, and just needs a little bit more flexibility when qualifying, because it's backed by the government. Now, the thing about FHA is really heavy on insurance. They're paying the government right up front. They're going to roll in basically 1.75% of the loan into the loan amount. And then they roll in it monthly too. So they have a double whammy of insurance. So it's heavily insured, and it can really bump that payment up a lot. But it does work for some people that need it. And the maximum loan amounts vary by county. Right now, I think the max loan amount for FHA, say in Dallas County Metroplex area, is $411,000.
And so one thing to know about FHA, so when you have a conventional loan, the lender is going to require an appraisal. FHA also requires an appraisal, but it's kind of more of an inspection appraisal, where there's certain criteria that the house has to meet. And so like really old houses, it may be hard for them to qualify for FHA because there's going to be too many things about the house that the inspector/appraiser won't accept, like if the windows are painted shut or just things about an old house. So it's a little bit harder, I would say, for a house to qualify for FHA than conventional. And so you need to be mindful of that. That's a lot of times if you're working for first-time home buyers and they're FHA, and we're in this crazy market right now where everyone's getting multiple offers, an FHA offer can be seen as less attractive because there's not just an appraisal hurdle to jump through, but there's an inspection and appraisal hurdle to jump through. And you're also not allowed to use the appraisal waiver with FHA loans. So that's just something to be aware of. And then also, if you have a listing and you have a buyer that's FHA and it appraises and it doesn't meet value, that appraisal will run with the property for a certain amount of time. So if in a month later you get another FHA buyer that comes, that previous appraisal sticks to it. I think it's 3 months, but I don't want to speak out of turn. Is that right, Lisa?
Yeah, I believe it is 3 months.
So that's just something for you guys to be aware of, whether you're working with FHA buyer or seller. They have a little bit more teeth in them, I would say. So that's why sometimes sellers are more hesitant. But sometimes it's the only option, and it's a good option for buyers, and when it's not such a crazy market.
Okay, so as you can see, the sweet spot for the FHA credit score is right, between, I think someone just popped up there.
Yeah, Jackie's asking, with respect to jumbos with a private bank, do those not require appraisal? No, I mean, anytime there's a loan,
yes, they require appraisal. And sometimes if it's over $1.5 million, they're going to require 2 appraisals. And they really scrutinize the appraisals nowadays. I mean, just so there's just a lot more overlays on jumbo loans, especially on the appraisals. So
And we're going to get into that in a little bit more detail at the end when we're going over the forms.
But
Good
as
question.
you see on FHA, this is kind of the credit score range for people that, you know, get FHA loans is in there. And as the higher it goes, the lower it goes. Because really, if your credit score is that 750 to 799, why would you want an FHA loan? I don't understand it, but I guess some people do it.
Okay.
And VA loans, okay, VA loans are awesome. They are the easiest loans to do. Everybody wants to, you know, they're just, and now you can go jumbo on a VA loan with no down payment. I just did one for a pilot, and he got into a $900,000 home, and he just had to pay his closing cost. So it's a really good source. And I don't think a lot of that's realized that they can go into a jumbo category for VA. But as long as they have their full entitlement, then they, you know, will be able to qualify in their income. But the ratio requirements and everything is so flexible on VA. Like I said, it's a really solid, easy loan to do for a lender, since it's backed by the government, and they really want to support the veterans.
Lisa, is it similar to and I don't know the answer to this question. Is it similar to FHA where there's like a inspection / appraisal, or is it just an appraisal?
It's a little bit more stringent on the appraisal, but they have to, the appraiser has to be approved through VA to do it. So a lot of the appraisers do have that to where they can do a VA appraisal, but when we're doing a VA appraisal, we have to put that order out, and it does take a little bit longer to get it accepted. And then on that, one other thing on VA, it's kind of capped on the closing costs they can pay, but that's what people kind of are like, oh, well, we have to pay extra cost if my seller takes a VA offer. It's minimal. It's minimal. I think the only thing that they can't pay is like the attorney fees. So the attorney fees might be, you know, like $175 to $300. So that may be the only thing that the seller would have to pay on behalf of the veteran, is the attorney fee. Now, if they're going with some other lender and they have obscure fees, then those might not pay, those the seller might have to pay. But if you're going with a traditional lender, they're not going to have a lot of junk fees in there. So that would be the only other thing I could see that would be where the seller, you know, might have a question on what they would have to pay extra to do a VA offer.
Yeah, so I have an agent commenting that there's a little bit of stigma with VA, kind of like there is with FHA, but is that because the appraisal standards are slightly more strict, or is it just people don't understand them?
I think people don't understand. I actually think VA is stronger than, well, they're both government backed, but VA is people just don't, when they don't understand it, they don't know, kind of, like I said, what expenses like.
Okay. They've lumped it in there with FHA, but they don't really understand why. So now you guys are ahead of the game.
Yeah.
There we go. All right, thank you.
Now, this loan, I have never had the opportunity to have the pleasure of doing a USDA loan. It's on farmland and raw land, and it's really out in the boonies. And so since there's not a lot of land anymore in the Dallas area, we do these loans. Cornerstone does these because we do all through the state of Texas, and we have, you know, in different states. But basically, there's an income cap. The clients can't make a certain over a certain level, and then it's basically like an FHA loan, but it is on land.
So you have to have a certain type of property to qualify for this loan. So this probably isn't going to be frequently used by you guys at all. I can say I don't think I've ever seen one come across my desk. So, hey, Lisa, we had a question about VA. Doesn't it take twice as long to secure?
No, as long as the biggest thing is once we get that appraisal accepted, it really doesn't take, it doesn't take long.
Okay.
The key is get them pre-approved because their certificate of eligibility needs to be updated by the VA, and that can be done online. So a lender can do all of that and get them pre-approved. So everything's ready to go. So they can offer a 30-day close.
Okay, good. Good to know. Thank you. Good question. All right, let's talk about condos because this is a
Oh,
big.
the fun condos, warrantability. So basically, condos to qualify for conventional financing that's backed by Fannie Mae and Freddie Mac, which most of your clients are always going to do, condos need to be warrantable. And basically what that means is it's almost like another set of underwriting. Your client's credit and all of that is one set, and then the condo goes through scrutiny too. And there's really three things. That's what we look at is we get all of the HOA documents, and they're going to look at the budget. They're going to look at if the number of units, if there's one person that owns more than say 3 units in a 20-unit complex, that will prevent that condo from being warrantable. So the first thing we do is we send out that questionnaire form. It's a 3-page, I printed one out. It's 3 detailed pages that the HOA will complete. And it just basically goes through everything. And then when we have a condo department, and that's all they do. They're slammed. They actually have to look at every single condo and go through all of this. So when you get a listing, the best thing you can do is find out if that condo is warrantable. And sometimes they'll be warrantable, and then 3 or 4 months later, they'll be non-warrantable because things change. For instance, for the blanket insurance, especially when we had all the storms back in the winter, a lot of claims were made, and the HOAs are still waiting to be paid through insurance. So that has literally depleted their reserve account. And lenders require that there's at least 10% reserve after they make all of their assessments. So a lot of times that will also prevent a condo from being warrantable if they don't have enough reserves in their budget.
So
Asking on an FHA loan for a condo.
yes.
Okay, yes. Now FHA is a little bit different. They actually will review and do inspections on a condo, and you can go online. It's HUD.com. I'll send you the link. It will allow you to put the property address in there, and then it will pull up if it's approved through HUD or FHA. So a lot of times what happens, the initial development will be approved, but every year FHA or HUD has to inspect it to keep that approval going. So a lot of times the HOA kind of just lets that expire, that nobody really thinks to do it until somebody wants to do an FHA loan on a condo. And then the lender can actually reach out to HUD and try to get that all in motion. But that does take time for the inspection and then to have it be approved again. So that's kind of a moving target on FHA. But yes, the developments that they approve and that they stay current on their inspections, they can make loans on, or we can do loans on it for FHA. I'll send you guys the link because it's so helpful to know that.
So is there a way, is that the same site that you can determine whether any condo is warrantable? What's the right way?
Well, see, there's no site that's going to determine what that is because like I said, it's a moving target. Things change, storms happen. It can make a condo, if their budget's not where it needs to be, then that can prevent.
Uh-oh, we lost you. You froze for a second.
to
Can you
make
guys,
sure it is warrantable.
okay, maybe we froze. Did you guys catch that? No, you froze, Lisa. I'm sorry. Can you give us
Oh,
the Cliff Notes again? I'm sorry, you froze.
oh, that's okay. I was just like, blah, blah, blah. So,
That was a great answer, but we didn't hear it, so.
so I guess um,
Basically, what do you do? If I have a buyer that wants to buy a condo, what should I do? I can ask the listing agent, is it warrantable? And if the listing agent doesn't know, where do we?
a
Have the
great
listing agent
way,
know?
yeah, a great way too is look at the comps. And if you have, 3 or 4 sales in there and they've all been conventional financing, that's a really good determination that it's probably warrantable, that recent sales that have sold conventional financing. Um, and then also reach out to the HOA, whoever does the HOA, like, Worth Ross is really good. Sometimes I can call them and just say, hey, Katrina, is this development, what, and they can tell me. Or if some of them will just say, oh, well, we have to fill out the questionnaire. We can't tell you anything. So then, then we'll send the questionnaire out and then get everything completed. And the title company too, a good thing is to always get your HOA documentation or your docs ordered. And the title company is really good about getting all the HOA information in too. So when you do have a listing, you want to get that started right away.
Yeah, two things on that. If you're the listing agent on a condo, you should definitely have the answer to that question and even know some lenders that have financed properties here before, because that's probably the path of least resistance, just to make things easier. The second thing on that is, yes, the HOA documents are a huge, huge thing, because the lender has the right to say that this doesn't meet underlying criteria based on the HOA documents. And I literally had an agent 2 years ago call me in the Plano office. It was 3 days before closing, and the buyer had terminated because the lender had finally looked at the HOA documents and said, this doesn't work for us. And they thought they had been sitting there ready to close. So you have to get those delivered ASAP and make sure that the lender has them.
Right. And also pending litigation, if you've got like a homeowner that's suing the HOA, I mean, that could prevent it from being warrantable. Another thing too is if, say, the HOA is suing the developer for anything like construction related, that's going to keep it from being warrantable until that litigation is resolved. So and like I said, it can change. It can change. That's why it's so important that every condo goes through the scrutiny. And that's what we do, is we do the whole questionnaire form, review the budget, review the insurance, because they want to make sure everything it's full. And the blanket insurance on a condo needs to be full replacement cost. So if anything happened, if it burned down, they're going to replace that 100%. So there's a lot more that goes into the condo.
Yeah.
And what that means too for a loan, there's a little pricing adjuster on the interest rate. A lot of people don't realize this, but there is. So for instance, if today's rate on a single family home or a townhome, which are different than a condo, that would be say 3%. And on a condo, there'll be like an 8% adjuster. So it would be like a 3 1/8 rate. So there's just a little adjuster for a condo loan.
Interesting. Barbara Schweitzer is sitting here with me.
So I just had this situation occur like 2 weeks ago, and my clients wanted to go ahead and purchase it, even though the condo cannot be warranted at this time. And the reason is because the developer is not finished developing enough, so they own over 50%.
And they control they have the HOAs, so
right.
It has been over. And you know what? There is financing. Let me tell you all, there is financing for that. Like your client probably got they had to probably pay 20% down. And
yeah, Barbara can tell us what did they end up doing.
Well, actually what happened is Village Homes has a lender that works with them all the time on these as they're not warranted. And they were actually able to get, I think, 3.75 rate, which was not bad. I mean, it's not that much higher, luckily, right now. And then they did not have to do the 20% down, which I was surprised. But this lender works with them all the time. And so it sounds like, they just have a really good deal with that lender. So you may want to find out, does the developer have a preferred lender that could help if it can't be warranted?
Yeah, so usually just have that in the back of your head. If you're trying to help someone buy a condo and the listing agent is trying to get to use the preferred lender, that's probably the reason why, because
Right.
it's not warranted
Yes.
yet, but they have a lender that has agreed to loan on the condo, so.
And they were
Exactly.
and they
Yeah.
said, this is not warranted. We want to let you know that
Yeah.
up front. They were super upfront about it. So it was great.
That's a
Like,
good listing agent, right?
Yeah.
Yes, that's awesome. And another thing too, if you have someone that really wants it, there is financing out there. It's just not your traditional standard, 30-year fixed. A lot of times there's the adjustable rate mortgages they offer. So there is financing out there for non-warrantable condos. It's just not the standard.
Yeah. Okay, awesome. Okay, so now, guys, what we're gonna do is first of all, does anyone have any like lingering questions out there in general? Because what we're gonna do is go through the forms that you're gonna use frequently that deal with financing so that you can kind of understand the nuances and understand how to fill them out and understand strategically what should go in the blanks. And does anyone have any questions before we kind of turn to the forms?
I actually have one question real quick. So, going back to the pre-approval for the buyer, does so the buyer has to be pre-approved, but what if like the client is like taking long to find a home? Is there like an expiration where they have to like resubmit the application or?
The pre-approval is actually good for 90 days. That's how long
Okay.
the credit report is good. So and then I've worked with some people for this one couple, they're working with Briggs agent. They literally had put almost 30 offers on homes and they kept getting bid and that bid. We've been working together for over a year.
Oh my God.
And then finally, yay, they finally got under contract. We were so excited. It was like, oh my gosh, I'm so for this couple. It was awesome. They got a house. But yeah, I mean, when I work with clients that are pre-approved, I kind of keep everything updated, kind of update stubs. So everything's fresh when they do find a house.
Yeah, the only reason I ask is because it has been more than 90 days and I spoke with the lender. I had my buyer, speak with the lender, and he said as long as there's no major like financial things that she bought, it's fine. And I was like, it's been September now, so.
Well, the thing is that it probably is fine, but when they do get something under contract, they're probably going to have to go through underwriting. Yeah. If you want to have them officially gone through underwriting, just ask the lender to do it and update it.
Right. And then we'll just update the credit report too, because you never know. And I always tell clients when I'm working with pre-approval, when they're starting, like, don't go buy a car. Don't go do anything while you're looking for a home, because what happens is we pull that credit, and even though it's good for 90 days, what all lenders do is 1 week before closing, we do a credit refresh just to make sure they'll buy a car. So it's really sneaky. So if the client's not aware, sometimes they like, I'm going to go buy furniture, or I'm going to go buy, whatever. And then if they do that, then we have to kind of go back to funding, because their ratios have changed because they have a bigger, monthly debt payment or whatever. So well, don't do anything until after you close on your house.
Okay, so 90 days. Awesome. Thank you so much.
Okay. So while we're talking about approval and pre-qual, let's just look at this financing addendum, and we'll go back to paragraph 1, but let's just stick with paragraph 2. So this finance, and Lisa, you interrupt me here if I'm saying anything that you think you would disagree with as the lender, because it's helpful. So in paragraph 2 is where this is the contingency part, right? So, and there's 2 contingencies. 2A is on the individual buyer getting approved, and 2B is on the property getting approved. So you have 2 separate contingencies built into this document, and they're separate. So if you have a buyer that's totally pre-approved, been through underwriting, has done the whole thing, and you want to make your offer more attractive, you can check the box that says the contract is not subject to buyer obtaining buyer approval, but only if you have worked very closely with a really good lender like Lisa and you know that there's not any questions and that they're already approved, right? That's one hurdle you've already jumped before you even go under contract. Like, that makes your offer more attractive, because that one of the two contingencies is not in the contract anymore, because you're saying we're already pre-approved. There's no contingency on this buyer. Does that make sense? If you haven't done that and you just have a pre-qualification, then you're going to check the first box, which says this contract is subject to buyer obtaining buyer approval. And then you're going to ask for a certain amount of days. And Lisa, what's the appropriate amount of days? I usually tell people 10 to 14. I mean, right now,
Perfect. Yeah,
that's
that's perfect. Mhm.
so if you don't have if your buyer's pre-qualified but not pre-approved, check with the lender, of course, and make sure they can turn it around this quickly. But generally, you should put 10 to 14 days. If you've done the legwork already because your buyer really wants to get the house and doesn't want this contingency in there, then you're going to check that box on page 2. This contract is not subject to that, right? So that's the part of the contingency that has the time frame to it, is the buyer getting approved. The property getting approved, and this is something that I have even super experienced agents get confused on. They're like, well, we have to get the appraisal within those 14 days or else we lose our contingency. That is not true. The property approval lasts for the duration of the contract up until 3 days prior to contract. So if you get the appraisal 5 days before closing, but the individual, those 14 days have already passed, right? Your buyer is qualified, those 14 days have passed, but you get the appraisal 5 days before closing and it doesn't appraise, your buyer still has the right to terminate and get their earnest money back. It just has to happen no later than 3 days before closing. Does that make sense, guys? That's a big nuance that like agents that have been in the business for a long time don't understand. You have these two separate contingencies.
So there's no like cap on that day, like in Georgia, we would do a 21-day appraisal contingency or a 30-day appraisal. Like if it were a 60-day close, that way the seller wouldn't have to be at risk till day 57 as it is here.
Yeah. No, the cap is not later than 3 days before closing here.
Wow.
So, but you can go ahead, it is risky. So, and that's why people want that. They try to waive it, and you can waive the appraisal piece, right? With this appraisal addendum we're going to look at, but you can't waive the insurability piece with respect to like the HOA documents or the insurability, like in terms of the condition of the home. So you can't waive those items. So just something to be mindful of. That's a good question. And like that was the example that I had where, 4 days before closing, the listing agent called me in a panic because the buyer had terminated and they were totally within bounds, unfortunately. So does that make sense, guys? Understanding this addendum is super important in how it works. And I'm going to kind of pass it back over to Lisa to talk about paragraph 1, because what I usually say when agents don't know what to fill in the blanks there, I say, call the lender and have them tell you what to put in those blanks, right?
Another way, a good cheat sheet here is to follow your pre-approval letter, because that pre-approval letter has been tweaked to match your offer. So you're going to just follow that because it's going to give your loan amount. It's going to give whether it's a conventional, an FHA, a VA, it's going to give you all of that. So you just go down and say your pre-approval letter says it's a conventional loan and the loan amount is $400,000. You're just going to go and fill that out based on your pre-approval letter.
Okay. And then in this paragraph 4 with FHA or VA, if the financing described above involves this, it is expressly agreed that notwithstanding anything else, what goes in that blank? Because it says, or I always say put the contract price, but then it says, or the contract price.
But that's regarding the appraisal amount, right?
Yeah.
So on FHA, the client can agree to pay more than the sales price.
Okay.
If for some reason the appraisal comes in lower, okay, if the appraisal comes in lower, that person can actually pay the difference.
Right. Okay.
So
got it.
that's
okay. Okay. Good. Okay. So now any questions about this financing addendum before we move on? Okay. So then this next one, the very popular right now, addendum concerning right to terminate due to lender's appraisal. And there's 3 different boxes you can check here. And if you're the seller, you want the first box to be checked because it's a total waiver of the appraisal. If the property's $1 million and it appraises for 700, but the buyer has checked that first box, it doesn't matter. They don't have the right to terminate no matter what the appraisal comes in for, right? That's an easy one. That's the one you want to see as a seller. It's very risky for the buyer, right? Because you have no idea how it's
Yes.
going to appraise. The second one is what we see more often. And it's basically saying the buyer's going to waive the right for the appraisal as long as it appraises for this much. And that's what you put in the blank, right? So if it's $1 million property, the buyer may say, I'm willing to buy this property as long as it appraises for 900, right? So that's the number that you put in there. If it appraises for less than 900, then they still have the right to terminate. If appraises for 901, then they've got to bring that extra money to the table. Does that make sense? So that's the partial waiver there. And this trips people up a lot. And if you have questions about it, like call me, call a manager, call someone. Like sometimes you just have to do the like mental pretzel of thinking this through when you're doing it. So make sure you get it right, okay? And then the last box, so this is a box that you use. This box actually protects the buyer and preserves their right to terminate in situations where, say, it's they're buying this $1 million property, but they're putting down 500 because they want to stay below jumbo and just get a conventional loan. So if they're putting 500 down and the property only appraises for 750, the lender may not care because the lender is only financing, the lender doesn't, the LTV is good for the lender. So the lender may say, well, we're not going to make you terminate because this is enough for us because you're putting so much down. So in this case, this will protect your buyer and preserve their right to terminate if they're putting down a lot of cash. Does that make sense?
Because
Because usually
really good option that they had added recently, that option right there, which is good because that's happened a lot where
yes,
it was never addressed before. So that's really good.
yes, and you see that usually you see this with like you only see it when buyers are putting down a ton. And it protects them. So you just have to remember, people are always like, what is this for? Like, don't use that unless your buyer's putting down a lot of money. Does that make sense? I feel like we go over this form like every other day, but it's really confusing. So hopefully this is helpful.
I will say we had one situation that was weird this year. So we were selling something and they chose option one and they waived.
Yeah.
But what happened is we got caught with the appraisal did not come in and it screwed up the financing. And so we had to actually come down and accept a lower price in order to make the deal happen because of the financing piece. Like somehow the numbers didn't work for the lender at that because it didn't appraise at that. It was like
so the buyer could
10,000.
just bring the extra money?
They couldn't. Like the lender said, I won't do this loan.
Oh, okay. So
lower the.
So basically the buyer would have had to bring so much extra cash because it didn't meet the appraisal, that then it affected their like asset ratio.
Yes, that's exactly right. Yeah.
So you just have to be careful.
Yeah.
You have to be wary of
So I
that.
just wanted everyone to hear that.
That's good. It's not a slam dunk, right?
Yeah.
Option one is checked doesn't mean you're home free.
Yeah. Because did that make sense, guys? That basically this buyer, they checked box one and said, we'll bring whatever we have to. And they had the cash to bring it. But if they took the cash to make up the difference, then it messed up the rest of their loans because their, asset debt to income ratio was off. So you have something, that's a good point to be mindful of. Okay. All right. Any questions about this form? Lisa, go ahead.
That would kick in their financing contingency because their loan would be declined, right? So that would just negate that whole waiver.
Yeah.
Right. So we actually.
I haven't seen, that's interesting. I haven't heard of
I've never seen that, but that's interesting.
Yeah.
It's been an interesting year.
It always is. Welcome to real estate. Okay. So now we're going to go over, guys, it's 10 o'clock. So if you have to fall off, that's fine. We have a couple more forms this is the rest of these terms are all in the 1 to 4, but I just want to point them out to you so that you're aware. So this is section 7E and 7F of the 1 to 4 contract, and it's basically dealing with lender required repairs. This is one of those sections that you're never going to understand fully until you're in a deal where it applies. But I just want to point out to you that this is here, is that like particularly with FHA, the lender may require certain repairs. And then this is what governs how you handle those, right? If they're minor repairs, the seller is not obligated to do any lender required repairs, but then the buyer can terminate. right? And if the lender required repairs come back and it's more than 5% of the purchase price, then the buyer can terminate because they may say this house needs too much work. So just something to be aware of, that this is in here. And then also, go ahead.
Can I add one thing to that?
Please.
Appraisals now, they do not, they're as is appraisals. They do not require any repairs unless it could be a health or safety concern. If there's a broken window, if there's a rail that's missing off a stairway or something, they'll require those to be completed. But other than that, very, very, very rarely will see that. And like I said, unless it's a health or safety issue.
Yeah, and that's and I mean, it's usually with FHA, right?
Yes.
Yeah.
But no, conventional too, if it's health or safety, a conventional appraiser would,
very rare on conventional, but
yeah, very.
Okay. All right, questions about that? Okay, so then the next section, and this is a big one, and it's just 12A1B. 12A1B, you just need to remember that. And that's the section of the contract that deals with like a seller credit at closing. So a lot of times if you're, negotiating during the option and the buyer wants X, Y, and Z done, the buyer may say, I'd rather just have a credit at closing, and I'm going to go do those repairs myself versus having the sellers do them with their own vendors. The buyer may be like, I'd rather contract with my own vendors, and then I know, and I make sure it's done properly and blah, blah, blah. So a lot of times the buyers will say, instead of making these repairs, I just want $2,000 to cover so that I can keep that cash in my pocket and pay my repair people after I close. Does that make sense? Yes. So the trick about this number is that there's a limit to what buyers can get back from the sellers, right? You can't say on $100,000 deals, the seller's gonna give back $50,000. Like, that's not going to work for the loan. So when you're putting a number into this blank and it's getting high, I always tell the agents, talk to the lender and make sure you know what that number is. Because if you put 50,000 and the buyer's really only allowed the credit of 4,000, then you're just giving away that money that you negotiated for. Lisa,
exactly. And a good rule of thumb is it just can't exceed what the closing cost and prepaids are.
Right.
So as long as it's not more than the closing cost and prepaids, you can have that credit. But if it is, then that's money on the table that might be left.
And if you're negotiating and if you're like, man, this is $15,000 worth of repairs and this is a $300,000 deal, like, call the lender. They can tell you the exact number that you can put in that blank and still get credit for. Because if you put a number that's bigger than that, you don't get the benefit of it. Or you as the agent are paying it for them or something. So just be aware of that. But there's even in the amendment form, which we don't have in these slides, there's a specific box that says the amount in section 12A1B is changed to this much. So a lot of times.
Please make sure that the lender and title company get all of those addendums, because I can't tell you how many times we're preparing the CD, the client is looking at the CD, and it has to go out 3 days prior to closing. And they're like, well, the seller was going to pay $2,000 in lieu of repairs, and it's not on here. Well, then we have to scramble because the title company doesn't have the addendum. We have to reach out to the agent to, hey, do you have an addendum? Oh, I forgot to send it to the title company or so please make sure, because there's a lot that happens that slips through the cracks that we don't get that credit on the addendum. So
that's a good best practice, is anytime something gets executed officially, it needs to go to the title company and the lender. Just make it easy on yourself. So while we're on this subject, Lisa, I know a lot of times, like, agents, people feel like the lender doesn't want to see repairs, right? That they're like, oh, you have to replace the roof, or, oh, this isn't working. Like, they're afraid it's going to freak out the lender, so they don't want to show it to the lender. Can you walk us through, like, what's the best practice around that from the lending side?
Well, if it's something like a major repair, we kind of want to know, because if the appraiser's out there and they're putting a new roof on or something, so yeah, we kind of want to know. But if it's a bunch of nitpicky little repairs that can be handled, relatively easy, if you have it on the repair addendum, if you have it all listed out where, we can get like the paid receipts from the contractor. We have to have that prior to closing. So I always reach out to the listing agent. I'm saying, hey, Do you have the receipts for, you know, the plumbing or whatever, to make sure we have those. But that's
your buyer anyway.
and another thing too is if you have a lot of repairs, it is the contract's part of what we give the whole contract to the appraiser. So if there's a long list of repairs, that appraiser might say, oh, we have to make this appraisal contingent on all these repairs. So then they have to go back out and make sure all those repairs are done. So it's really good if you have a situation where there's going to be a lot of repairs, just call the lender and say, what's the best way to handle this?
Awesome. Okay, thank you. I know that always comes up, and I'm always a proponent of just putting everything out there and solving the problem and just being proactive about
I
it.
think that's
There's
good.
a way to solve the problems that we face here. So, okay, last forum, guys. So thanks for hanging with us. It's 10:06.
And this one is always wrong. The very few people get this one right. Always remember, put 0 up there, especially like if they're leaving their refrigerator and their lawn furniture. You don't want to put $250, or you don't want to put any amount of money, put 0. And it's fine. You can list as many things on there as possible, but just don't put a dollar amount. If they want to buy the lawn furniture and the seller is adamant about selling it, handle that outside of closing. Don't put it on the addendum. Just let them handle that in between themselves, okay? But really, this is super easy if you just remember, put 0 up there. Because if you, then, you know.
And so a lot of times, guys, where people get tripped up is like if someone's buying a lake house and they're like, oh, we're going to sell you the boat and the RV also with it, and it's all priced together. Well, the lender is like, I finance houses. I don't finance boats and RVs, right? So you need to talk to the lender about the right way to handle that. Just, it's common sense, right? Like the lender is financing a house, not these other things. So if the price for all of it is 1.5, but the value of the boat is 100, you have to just paper it properly, and you might have to have some separate documents. You just, because a lender wants to finance the asset that, only the asset that it's, the value of the asset that it's secured by, which is the house.
And then the appraiser's going to get a copy of this too. So if the appraiser sees a boat on there, they're going to think, oh, well, I have to back that value of, what's the value of that out of the appraisal, because it can't be part of the real estate transaction. So
yeah. And I mean, there's all of these problems can be solved and papered properly. We're just having this discussion right now to make you guys aware. So hopefully that was helpful. I'm going to flip to the next slide, which is just the calendar of what's coming up. But I know that there's some of you guys have questions. Lisa, if you have a few more minutes, if you could stick around to answer questions, that would be awesome. Thank you.
And then if they want to email me, that's fine too, whatever works.
Yeah, well, we'll get some of these documents and websites that we talked about, and I'll forward it to everyone and CC you so that they all have your contract. Thank you so much for doing this for us.
Oh, my pleasure. It's been fun. Y'all have a good weekend.
Yeah. Okay, Brian, did you have some questions?
I do. Thank you so much. Lisa, bear with me. I have 3 questions from the presentation today, so I'll try to make them as quick as possible. So first of all, going back to the income portion, when we're calculating out the qualifications of a client, so I'm thinking about people like myself, for example. I left a job of 14 years to start this career. So going from guaranteed paycheck to self-employed. And what I did is I cashed out my 401k to supplement my income for this year. So if we have somebody who's done that, taking either a loan from the 401k or cashed out a 401k to supplement income, how has that looked on their annual income?
Well, you can't really give it credit because it's not going to be, it's usually a one-time thing where you're pulling that money. Now, if you have an investment account and you're getting distributions from that account, as long as it can support 3 or more years, we can give you credit for that income. But a lot of times when you're tapping into the investment or the 401k, it's just a one-time shot.
Okay, that makes sense. So secondly, I'll move forward to the VA loan. So I know that we had talked about the VA loan and kind of the stigma that they carry. And the way that I've seen in my experience so far is that we have conventional, which is awesome. We kind of move down to FHA. And then what it seems like is that we kind of move down the funnel from FHA to VA as far as what the hierarchy almost of them are as far as preferability. So I understand the comment as far as people don't necessarily understand them, but being a veteran myself, I want to be able to help vets as well out there to be able to get into a home. How can I, as an agent, help the seller understand more about them and not have this negative stigma attached to them?
That is a good question. I think just with education, I mean, just having that veteran be fully pre-approved, everything solid, and talking and having the seller reach out to the lender to assure them of, you know, the quality of the loan. And honestly, I love VA loans. They're so streamlined and easy to make VA loans. And I wish that sellers didn't have that negative thing when they get a VA contract, because like I said, I think the reason is old school. They used to have to pay a lot more, and there used to be a lot more requirements on the appraisal, but that's so lightened up. And I think it might even be $300 for the attorney fee is what the seller would actually pay on behalf of the vet. So it's really not as daunting as in the old days.
Okay.
Changed a lot.
And then my third question, I'll make it super fast here. I have a client that I'm currently working with who has a relatively low pre-approval, less than 200,000. So trying to find her a home is next to impossible right now in this market. But she currently is in a situation to where she may be able to purchase her current property. She's FHA, and the property is requiring some substantial improvements or repairs on it. So one thing that was brought to my attention is the possibility of her looking into a 203K loan. Can you give me a little bit of insight as far as what that is?
Okay, so as long as you have, it's really intensive as far as the documentation. You actually have to have your contractor bid everything, your plan, the specs, everything has to be itemized out, but you can roll it into the loan, definitely. And there's also conventional, you can also do that on a conventional loan. If she could qualify for conventional, we do have that option where you can, the purchase plus improvements, you can roll those improvements in too.
So she can't do conventional, but is she able to do, so let's just say asking price for the house that she's in is about 125,000. She's pre-approved right now, FHA, to 185. So in this case, would she be able to do the 203K up to that 185 and use that, you know, 40 grand?
As long as the appraisal supports the improvements. So if that property will appraise out at 185 once those improvements are done, because they're going to do the appraisal as if the improvements are made.
Okay.
So, yeah.
Thank you very much. Appreciate your time.
Oh, you're welcome. My pleasure. Thank you, guys.
You're muted, Zareen.
Oh,
All right, I'll start over. I was just saying thank you so much.
oh you're welcome. I saw your mouth going, but I couldn't hear you.
What is she saying? Thank you, thank you, thank you. I think this was really helpful. We're getting good feedback. And agents, I'm going to send a little survey to you guys just to get your feedback too on things that would be helpful. So appreciate you guys. Thanks for hanging in there. And thank you again, Lisa.
Thank you,
so
guys.
much.
Take care.
Appreciate it.
Thank you, Lisa. Thank you.
Thank you.